Welcome, everyone. Look, if you're an ambitious founder looking to scale your business in India, you already know the deal. Capital is the absolute fuel for your growth. But here is the frustrating reality we've all faced. Collateral-free capital is often locked behind what feels like this impenetrable, giant puzzle of confusing paperwork. You've got the vision, you've got the drive, but man, the banking bureaucracy can feel completely overwhelming. Well, that is exactly what this explainer is designed to conquer. So let me ask you this. What really stands between you and the capital you need to scale? Is it your business model? Your sales pitch? Honestly, a lot of the time it's neither of those things. The single biggest frustration for business owners isn't a lack of profitability. It's just the sheer exhaustion of navigating banking bureaucracy. The answer is actually pretty simple. It's the right paperwork. And I want you to completely shift how you look at documentation today. Really, stop seeing it as a chore. I want you to think of it as your master key. Because when your file is perfect, you instantly move from being just another risky applicant to a highly fundable, serious business. Here is our architectural blueprint for today's explainer. We're going to cover core foundational documents, requirements by loan bracket, rules by entity type, purpose-specific loan add-ons, and finally, avoiding common rejection traps. Okay, let's jump right into Section 1, Core Foundational Documents, the mandatory baseline. So here is your baseline, individual KYC and business proof. If you're a proprietor, partner, or director, you obviously need your identity and address proofs. And listen, a PAN card is strictly mandatory. There's literally no bypassing it. Now for the business itself, unless you're a sole proprietor, you're going to need a firm or company PAN along with a rock-solid address proof, something like a recent electricity bill or a formally registered rent agreement. But beyond just basic identity, banks need to see continuity. They look for this through your GST registration, your UDIM MSME certificate, and your SHOP Act license. But here's an interesting little detail to keep in mind. A minimum 3-year vintage is highly preferred. Why? Because lenders absolutely love history. They want to see that you've weathered a few seasons before they hand over unsecured capital. Moving right along to Section 2, Requirements by Loan Bracket, Scaling the Ask. First up, we have Bracket A, microloans. These cover amounts up to 10 lakhs, and they're typically processed under government microfinance schemes, like the Mudra loans, Shishu, Kishore, or Tarun. Now, regarding the financials here, lenders are focusing heavily on your basic cash flows rather than heavily audited balance sheets. They basically want to see 6 to 12 months of bank statements, maybe a simplified one-year income tax return, and some self-declared sales data. Throw in your UYAM certificate and a non-default declaration, and you are good to go. It's super accessible, designed purely for immediate grassroots scaling. Now, let's step it up a notch to Bracket B. These are your medium unsecured loans ranging from 10 lakhs to 50 lakhs. This is the classic territory of standard commercial banks. Here, ITR means income tax returns, and they're going to want the latest 2 years. You'll notice a real shift here toward formal credit history and tax compliance. You absolutely need your GST returns, specifically GSTR 3B and GSTR 1, for the last 12 months. They'll also pull your Form 26AS, or Annual Information Statement, just to verify your actual earnings and TDS. And you'll need to hand over your unaudited profit and loss and balance sheet for the current year. Then we reach the big leagues, Bracket C, high-ticket funding. We're talking 50 lakhs up to 75 lakhs and beyond, which is very often backed by the government's CGTMSE guarantee framework. At this level, the appraisal is strictly data-driven. The bank demands 3 years of financial statements completely audited and certified by a chartered accountant, plus a tax audit report if that applies to you. Also pay close attention to the schedules requirement. They want an aging analysis of your debtors. If you have receivables just sitting out there outstanding for more than 6 months, the bank wants to know about it. Because at this level, they aren't just lending to your past. They are heavily analyzing your future projections too. Which brings us to Section 3, Rules by Entity Type, your legal zoning laws. Now, a sole proprietorship is wonderfully simple. The bank basically just looks at your personal PAN and Aadhaar, plus a couple of proofs with your trade name on them. But if you're running a partnership or an LLP, the complexity definitely scales up. You'll need the firm's PAN, the actual partnership deed or LLP agreement, and the KYC for all the partners. But the absolute crucial addition here is the authority letter. That's a legal document signed by everyone, permitting one specific partner to borrow on behalf of the firm. Trust me, without it, your application goes absolutely nowhere. And if you are a private or public limited company, well, you are bringing out the heavy corporate paperwork. You need the company PAN and your certificate of incorporation issued by the MCA. That's the Ministry of Corporate Affairs. You also have to include your memorandum of association, your articles of association, a certified shareholding pattern, and the KYC of all your promoting directors. It's the whole shebang. Also, at the enterprise level, you're going to need a board resolution. What exactly is that? It's a formal resolution passed by your board of directors explicitly authorizing the borrowing of these funds and officially naming the specific directors who are allowed to sign the loan documents. The bank basically needs bulletproof legal proof that the company as a whole has actually agreed to take on this debt. All right, Section 4, Purpose-Specific Loan Add-ons, Customizing the Build. This is where the reason you need the money matters. If you need a working capital loan just to keep daily operations flowing smoothly, the bank is essentially financing your inventory. So naturally, they need your latest stock statement, a summary of your debtors, and any existing sanction letters. But let's say you apply for a machinery term loan instead. In that case, they want to see exactly what they're paying for. They require a pro forma invoice from a verified supplier and a highly detailed profile of the machinery's model, capacity, and expected life. Basically, the purpose dictates the proof. Finally, we reach Section 5, Avoiding Common Rejection Traps, the final inspection. Seriously, why do fundamentally good, highly profitable businesses get rejected for loans every single day? It's almost unbelievable when it happens, but I promise you, it's almost never because they can't afford the repayment. It is almost always a completely avoidable failure of compliance right at the finish line. So let's double-check your files right now to make absolutely sure this doesn't happen to you. Here are the critical red flags that will trigger an automatic rejection stamp. Step 1. A pan-GST spelling mismatch. I'm serious. If the business name is even slightly different between tax portals, the automated system flags it. Step 2. Incomplete or low-res bank statements. Taking blurry smartphone photos of crumpled paper won't cut it. You have to download the authentic digital e-statements. And Step 3. Financial discrepancies. Your profit margins and turnover on the application form absolutely must perfectly reconcile with your filed ITR and your GSTR 3B. If they don't match, the bank assumes you're either committing fraud or you're just terrible at math, and neither of those is going to get you funded. 650. Okay, this number is absolutely critical. Well, it's obviously not a document you can print out and put in a folder. An individual CBIL credit score under 650 to 700 for the partners or directors, or a poor commercial CBIL score for your entity, will prompt an immediate automated rejection. And that happens regardless of how perfect your paperwork is. You have to guard your credit score fiercely. Before we wrap, I want to leave you with this ultimate highly actionable insider takeaway regarding your audited files. Ensure all financial certifications bear the appropriate CA's membership number and UDN. That stands for Unique Document Identification Number. If you're submitting Bracket C audited financials and your CA somehow forgets to generate and append that UDN, well, those documents are not considered legally valid by the bank. It is a tiny, tiny detail, but it will literally stop a 75-lakh loan dead in its tracks. So as we finish up this explainer, I want to leave you with this one thought. Is your document file truly ready for the bank? You now have the complete blueprint. You understand the core foundational documents. You know the exact requirements for your specific loan bracket. You get the legal necessities for your entity type. And most importantly, you know the exact traps to avoid. It's time to gather those files, audit your own paperwork, and unlock the capital your business deserves. Until next time, keep learning, keep organizing, and keep scaling.